Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we're doing a bit of an earnings preview. Obviously, we've had about 2 weeks of earnings kind of go through. We had Netflix report, ASML, TSMC, ServiceNow, a couple other smaller businesses, and we've had so far great earnings. It has been crushing beats after crushing beats and just overall very positive with at least the tech earnings that we've had so far. But this week, we're going to kind of see the back half of big tech report. So obviously we have both Amazon and we have Google in terms of the big tech companies that haven't reported. And of course we do have Nvidia that reports way later, but I kind of wanted to do like a little bit of an earnings preview and some of these companies that I follow, some of them that I actually own in my portfolio, which by the way, if you didn't know, I transparently track my portfolio pinned. Always the most current version of the portfolio is just always at the top of my Twitter, and like kind of my thoughts on like what changes have been made and that type of stuff, right? So you guys could always go and take a look at that. But yeah, with that being said, we have a couple companies in my portfolio, a couple companies that I'm looking at perhaps buying that are also reporting. So I kind of wanted to go through it. Now, with that being said, in order to look at what companies are reporting and that type of stuff, of course, there's a lot of charts that kind of float around on Twitter, but actually we have it natively here on finchat.io. And it's kind of one of the lesser known features that we have on the website. But yeah, just going through it, I mean, on the Tuesday, we have Google that is initially reporting. We're definitely going to take a peek at that. We then have Amazon reporting on the Thursday. Some pretty boring ones, McDonald's. You have AMD on, what is this, the Tuesday as well. Disney's a bit of an interesting one on Wednesday. You, of course, have Palantir reporting, I believe, tomorrow morning. We're probably not going to talk about that too much. And, of course, the company that I've been beating the drum on over the past handful of months, Uber, they're reporting Wednesday morning. So without further ado, I guess we'll kind of start it off by taking a peek at Google first and foremost. And so the big KPIs that I like to track with Google, obviously you look at growth and, EPS, revenue growth, that type of stuff. That's just a reoccurring thing. But in terms of like specific KPIs, I mean, right away, immediately, the number one thing that I look at every single quarter with Google, it would have to be the cloud revenue, right? And recently, I actually posted this chart, but I'll kind of demonstrate it to you guys here, where we have this feature called comment size on FinChat. And if you click on comment size, essentially what it does is, for example, Google Cloud revenue was $40 billion just over the past 12 months. It takes the 40 billion and it divides it by the total revenue. So what that tells you is what percentage of Google's total revenues is made up by, for example, just their cloud division. And so if we do that specifically with the cloud portion of the business, you could see a very clear trend over time of Google Cloud being consistently a higher and higher percentage of Google's revenues, right? And this kind of speaks to their diversification efforts over time of people kind of say that, oh, it's just the search business. That's the only thing that it does and that type of stuff. That narrative isn't really true and it hasn't been for a while. And we could kind of prove that here as well, right? So again, if we just go back down here and then we specifically click on Google search and other revenue, and I'm going to toggle off cloud revenue for now, you could see that since 2017, when they started reporting, when they changed the reporting period and stuff like that, you could see that it has gone down as a percentage. It still makes up just shy of 60%, obviously a very significant portion of their revenues, but it's starting to trend in another way. And this business is diversifying away, right? And so another thing that I kind of like to look at with Google in particular, because in my opinion, the cloud segment is increasingly becoming the most important part of this business. I like to look at the Google Cloud revenue growth rate, right? And we're down on a quarterly basis, by the way, here. So simply looking at, for example, Q4 to the year prior's Q4. And you can see in the most recent quarter, even though I believe the stock actually traded down when they reported this quarter, but cloud revenues accelerated to new highs that hasn't been seen since 2022, right? It grew 35% year on year. And that's just absolutely astonishing, right? So maybe this quarter, I probably wouldn't expect an increased continuation of this. I don't think we'll make it into the 40s, but maybe it flatlines from there. Even if it goes down to below 30 or hovers around 30, I would personally be very happy with that. Again, we're talking about what is this, $40 billion revenue or 11 billion a quarter. So yeah, I think it translates to roughly, $40 billion revenue business growing at 30%. That's absolutely unheard of, right? So I definitely don't think that's sustainable for a very long time, but definitely still something to keep an eye out. Another sort of theme with Google over the past handful of quarters has been that they have been raising operating margins massively. And the big sort of improvement was in the March quarter, but then we've kind of seen a continuation of that over the past handful of quarters. It's just been incredible to see, to be quite honest with you. I mean, this was a company that has historically been seen as very wasteful. And so we've kind of stabilized around this like 30% operating margin area. And so that's probably another metric that I'm going to be closely following. Moving on, the company that I've been spending God knows how many months it's been now, but just a very long time researching this business. I've spent countless hours going through financial reports, looking at every single interview that the CEO has put out over the past 5 years. I've really done a lot of due diligence on this business. I know it in and out. It's of course Uber, and I have a lot of conviction. I have a lot of money on the line. It's currently about just shy of a 10% position for me, but with the amount of cash I have at the moment, and maybe depending on how expensive CRM gets, maybe I'll trim a little bit of my CRM to put into Uber, but we'll see about that. This is a company that I'm definitely still interested in building into a bigger and bigger position. I think it provides excellent value below the $70 range, maybe even like into the mid 70s. I think it's a great business, but that's not the sort of video we're making today. Instead, what are the big KPIs that I'm going to be looking for with Uber to kind of see? And, of course, there's the Waymo risk with this business. So what are the sort of main things that I'm looking at to see if Waymo's, which it's very small, it's only in a handful of cities, but like, are there any early signs of that taking share, for example, right? And of course, first and foremost, the number one, probably the most important thing for this thesis to kind of fall through, we want to look at the growth rate of the revenues of this business. And again, I'm just simply searching for that. And I'm actually going to go on a quarterly view to kind of take a look at this. You'll see in the sort of pandemic period and kind of going out of COVID, this was basically a hyper growth business. A company that was growing 100%, 80%, 70%. But of course that deaccelerated into 2022, into 2020. They kind of hit the profitability lever. And at the same time, actually, your Uber Eats business, during the pandemic period, a lot of people were kind of trying it out and ordering in very high frequencies. And that all kind of slowed down, right? And of course, at the same time, like they, I wouldn't necessarily say they hiked prices, but they definitely increased the parameters for it to be higher priced. And of course, inflation kind of rampant throughout this time, but it was expected that, revenue slows down. But as you can see, we kind of troughed at a 11% revenue growth rate in September of 2023. And since then, we've had a handful of quarters, and it has accelerated every single quarter since. And actually, a better way to kind of showcase this is if we chuck it on a last 12-month basis, and you can see, particularly in the most recent quarter that they reported, in the past 12 months, our revenues has grown at a 17% growth rate compared to the period before that, right? And so, what you kind of have to understand with this business is that it's still despite it being like a $40 billion, it's a $42 billion revenue business. Again, similar to kind of like the Google situation, it's still a very, very fast growing business. And I guess this kind of ties into the second thing to watch with this is the margins of the business. We want to see continued margin expansion because this is a company that, again, it's hitting the profitability lever and it's almost thesis breaking if they aren't expanding their margins. And of course, back then they were like negative 50% operating margins. Right now they're, as of the most recent quarter, about a 9% operating margin business. So we want to see continued expansion with that. I think free cash flow margins are a little bit higher. I think they're about 15%. And then more specifically on the KPI side of things, the big things that are really important to me, first and foremost, is the monthly active users. This KPI on its own has grown. Well, actually, I guess this kind of skewed to the bottom. So maybe we'll zoom this in a little bit. This has grown at about 15% over the past handful of years. I just want that growth rate to continue, right? Uber is a business that is kind of reliant on a handful of things. So in order for them to continue to grow, you want to see continued users, monthly active users coming onto the platform. And then at the same time, you want those users to be getting Uber rides or getting Uber Eats in higher frequency. Because that's kind of the two levers the business could kind of pull on. You could pull on getting new users or of the existing users, getting them to use your product more frequently. And actually, we have that KPI all the way down here in FinChat. This is one of the newest KPIs that we actually added to the website. And it's right here. It's under monthly trips. It's kind of I don't like how Uber named this. It's monthly trips divided by monthly active users, right? And so if you toggle this on, and we would actually have to click this decimal button to kind of illustrate what I'm trying to point out here. But yeah, as you can see, since March of 2021, this has grown at about a 5% annual rate over time. So what this kind of showcases is that, on average, and keep in mind, this is average. So because there's a lot of Uber riders that are like in the category of 10 plus per month, it kind of skews it. If we were to take the median, I would assume the median would be like 2. But nonetheless, it's still a good proxy of like frequency growth with the business. But yeah, you could see this has grown at about a 5% clip over the past 3 years. And you can kind of think of it that way, that the average Uber user over time, every single year is using the Uber app 5%. They're, whether it be Eats or whether it be rides, they're taking 5% more rides per year. And so again, when we go all the way back to that roughly 15% revenue number, it's the combination of all these things coming online. It's the monthly active users growing. It's the frequency growing at the same time that's able to give them a 20% revenue growth rate, right? So that's kind of what I'm watching with Uber. And then again, in terms of the kind of Waymo risks, like there's not much to show for it, right? This business is going to put very stellar fundamentals. I would highly doubt that, they miss any of these numbers based off of Waymo risk or anything like that. Tesla doesn't even have a product, so we'll see kind of how that goes. And my guess is actually, in the end of it all, Waymo is going to probably be like a net benefit to Uber. Uber historically has had a problem with supply side, having drivers on the network. So I think what's probably going to end up happening is that in the Uber app, there's going to be an option for getting a Waymo ride, just like you could get at UberX, you could get Uber Comfort, you could get a taxi, you could get whatever you want, right? It's going to be another option there. Some people are going to opt in for that. Some people are not going to opt in for that. But what it does is it increases liquidity of the network. What does that mean? It increases the number of drivers in a given area. And of course, it's a very highly localized business. They operate on a sometimes state, city, or even airport basis. And so if you have a lot of drivers or, autonomous vehicles on the network, that's going to bring down expected time of arrival. That's going to bring down average price of the rides, and it's going to increase the reliability of the service. And so I kind of question whether a Waymo, and of course, they have the backing of Google, but I really do question their ability to create such a big network and, create essentially 8 million drivers across the 10,000 cities that Uber operates in. I question their ability to be able to fund that. I question their ability to be able to figure out the logistics network of that, the cleaning and taking care of all the AVs and all that type of stuff. I question their ability to do all that type of stuff without the help of which has the expertise to do all this stuff, which has the expertise of running a very complicated algorithm that is able to price it and is able to move demand and is able to put multipliers for drivers to go to a certain area to be able to earn a little bit higher income. It's very, very complicated when you really start to think of it from like a first principles basis of trying to emulate Uber. And of course, at the end of the day, people kind of think like Uber makes all the money from the rides for some reason. Uber only takes a 25% cut. So there's 75% of the gross bookings amount. When you get a $20 Uber, 75% of that money could go to Waymo. It could go to the fleet manager that is cleaning the car. Like it could go to all these different parties. And there's a very nice pool of income that all these different parties can kind of play around with. And based off whoever is providing a certain amount of value, they'll get a higher take rate of that gross bookings. Anyways, enough ranting about Uber. This is not the Uber video, but those are kind of the things I'm watching. I really want to see that monthly actives grow. I'm looking at that revenue growth. I'm looking at margin expansion. And of course, I'm looking at higher frequency growth with this business. Moving on. Finally, we have the big dog. This is the company that I have. At some point, I had, I think, close to maybe a little bit more than 40% of my portfolio invested in this company. As I've invested more into my portfolio, as I've brought in additional cash, it has made a lesser and lesser percentage of my portfolio. I have never sold a share of this business, and I probably won't for very, very long. With that being said, again, similar to the Google story, and maybe I'll kind of repeat myself here, I'm looking at AWS. I want to see continued growth with that segment of the business. This is the heart and stone of Amazon compared to, Google, where they make 60% of their revenues from search. With Amazon, it's a little bit less pronounced because on a revenue basis, it only makes up 16-17% of the revenue of the business. But then, and again, we have this over on FinChat, we have these KPIs, you go down to EBIT, or just operating income, right? And you click on AWS operating income, and we're going to toggle off the revenue for now. This is where it gets a little bit pronounced. You could see that AWS in the past 12 months alone, the cloud business has made up 60% of the operating income that Amazon has generated. And at some point, you might think like, oh, Arya, how is this possible? In 2022, it made up 170%. That cannot possibly be true. And the reason for that is because the other two parts of the business, the mixture of those two, and actually I'm going to do a stacked bar chart to kind of showcase this. Yeah, the mix of those two businesses was negative 20% operating margins and negative almost 60% operating margin. And so when you're looking at that and you're like, how could this be so unbelievably profitable? Well, it is unbelievably profitable. It's because the other two were in the negative. That's why there's that big of a discrepancy. But the point still stands, right? So I want to see how the cloud business is doing, because Amazon is almost just the cloud business in general. Like when you talk about Amazon, that's where the profits of the business are coming from. That's the engine of this business. And that's definitely the most important segment. So specifically with how AWS is doing, again, similar to the Google story, I want to see where is revenue growth going with that segment. Is, their investments into AI, is it actually meaningfully re-accelerating the revenue? And of course, I don't think AWS is going to grow as fast as Google. AWS is a $100 billion revenue business. Google's a $40 billion revenue business. It's 2.5 times larger. So it's definitely not going to grow as fast, but still 19% growth is very impressive. If it slightly accelerates into the 20s, I would be very happy. If it just maintains status quo, I would be very happy. Realistically, my mind's not going to change on Amazon, the business, if this swings one way or another. If it meaningfully drops, that could perhaps be worrisome, but I still wouldn't sell the business over something like that. Other than that, the other segment of the business that I'm kind of paying attention to and really looking at is the advertising segment of the business, which I'm sure many of you guys are familiar with this part of the business, but essentially it's the sponsored listings. So search up iPhone charger or search up, Sony headphones or whatever. The first 4 Amazon listings, they're going to be sponsored, and it's very highly targeted. It's very highly targeted and very effective ads because you're searching up Sony headphones and they'll put headphones right in front of you, right? It's very straightforward compared to something like Meta or something like Google. Well, I guess Google, it's pretty targeted as well. Again, it's you're kind of searching for it. But for example, something like Meta, where Meta has to kind of guess what would you like based off your engagement posts and that type of stuff. So arguably Amazon ads are probably a better form of advertising. Actually, completely random, but I think LinkedIn advertising, with the amount of data they have on you of your career, your age, your job history, your education, you could get very, very targeted type of demographic you're kind of reaching for there. Unfortunately, LinkedIn is kind of embedded into Microsoft. It's not an individual company for us to kind of look at. But anyways, just complete random side note. Going back to Amazon though, their advertising revenue is something that I'm definitely keen on kind of looking at. This part of the business has went from 5% of revenues to just shy of 9%, right? So just shy of 10% over the past, give or take, 4 years. And this is a incredibly fast growing part of the business as well. I believe it de-accelerated actually recently though. So yeah, okay, that's definitely something to watch for, right? So we saw that this has gone from a mid-20s grower down to sub 20% growth. And so that's definitely something to watch. And the reason for this, by the way, is because they increased prices on the sellers on Amazon's network, right? Because obviously not all products on Amazon are bought and sold by Amazon. It's like you and me, anybody could go sell them. And so they increased the sort of storage cost, the service cost, the fulfillment cost, that type of stuff a couple quarters back. And you could definitely see the pullback on advertising on Amazon as a result of that, right? So this is something to kind of watch with this business as we go on here. Now, with that being said, if you're interested in trying out this website for yourself, you could do so completely for free with the link in the description down below. You simply just have to sign up and it'll automatically apply 2 weeks free to your account. You'll get the full functionality version of the website and you'll kind of be able to do all this charting and access all these segments and KPIs and get the historical data for multiple years. And another thing I wanted to mention, I recently launched a Patreon and it filled out within a day and a half for the $1 tier. I now have a $3 tier. I am trying to be very generous with this, and this is very competitively priced compared to the rest of YouTube, and I'm even offering you a 7-day free trial, right? So again, that'll be linked in the description as well if you're interested in trying that out. We're having a blast over on the Discord. I'm on here every day. I'm dropping exclusive videos. We have a discussions board where you could talk about stocks and that type of stuff and really talk about very specific companies. But yeah, other than that, thank you very much for watching and have a great day.